And then there are the persistent longer-term questions about how long this is going to last, right? What is this cycle? There was a really interesting piece in Bloomberg this morning by a macro strategist named Simon White, who was drawing parallels between NVIDIA's new financing scheme and AIG and the housing crisis, right? And that AIG didn't think it was taking on risk. It was trying to offload all of that risk. And eventually it was. And he raises the question of whether eventually you will actually have a glut in chips that masks underlying signals. In other words, if there's all this cash out here to build compute, do you have a real read on demand if the push is such that you're building whether anybody is actually utilizing? I mean, if you look at the capacity utilization now of these GPUs, it's not super high. So I just think there are a lot still of longer term questions.
Well, that gets to the cyclicality also of chips, which is a question that on Wall Street is saying, oh, now it's perhaps these are longer cycles that you have, and also these chips, how long do they last, and how do the companies put those on their books as well? But this really gets to also the point of AI capex, how much spending is going on in this, and you're seeing the markets at all-time highs right now. If the markets were not at all-time highs, and if we were going on a 10% downturn, would you still be seeing this amount of capex?
So the idea is that if you securitize chips and compute and sell it off, then it's not necessarily a circular financing situation. That's NVIDIA's take. Do you think the broader market believes that?
I think there's an idea that at least now people's retirement accounts are involved. So you're spreading the risk a little bit beyond just a small group of tech companies that are both NVIDIA's customers and potential competitors. What's interesting is in my conversations with investors this week at these top AI labs, some of them say the $500 billion isn't even enough. It's going to put online about 10 gigawatts, which is what we're expected to need next year alone. So while that sounds like a huge number to us, $500 billion, to the AI companies that see compute as the future of our entire economy, it feels like that number barely scratches the surface.
So then just to be clear, who will the borrowers be? Who couldn't just pay cash outright for access to compute and chips that now will opt for the financing route to get access to this?
Part of it is some of the neo clouds and the neo labs that are some of NVIDIA's biggest customers. Think about a CoreWeave, a Cerebras, for example. Some of those companies could be turning to this financing, but we also don't know any of the details of these deals just yet, and none of them have actually happened yet. We also don't necessarily know the degree to which NVIDIA is going to be on the hook for some of that debt as well. So I think that's going to be one of the key questions. And then also, what the demand looks like for GPUs as a security is something else I'm going to be interested in. Obviously, there's so much demand for AI across the board. I'm sure investors are clamoring to get into it, but one of the key questions is what the value of these chips is going to be long term, and if that's going to be a fungible asset and one that, again, people want to be invested in longer term.
The broader criticism, even before all this, of so-called circular financing, people would sort of tag it as vendor financing, which is something that's existed for a long time. I mean, the problem there is if the seller of the equipment, NVIDIA, is lending the money that becomes their revenue, and there's really no productive use for it. In other words, wouldn't have been a customer otherwise. We're in a situation now where, at least if you listen to everybody in this business, there's just not enough, as you say. And so, therefore, we're facilitating the installation of this compute that's going to generate revenue because there's so much demand for it. Yeah. And maybe it kind of lets you sidestep the concerns about the vendor financing.
Right. Let's turn the capex concerns that Wall Street understandably has into an investable asset class, and then all that capex is totally fine. Right. So I think that's very well said.
Do people believe that it will be an investable asset class? Is that gaining some traction among investors?
Absolutely. I mean, a year ago, I covered this startup, Orn, which you guys would think is hilarious. It's these 20-somethings in a FiDi apartment who are doing $1 billion worth of GPU trading from this small townhouse in the course of just a month. And we know that CME, ICE, all these companies are trying to get in on GPU futures, spot trading. OpenAI is hiring finance team leaders that are going to work on GPU security. So this is something that there is a lot of demand for, sort of treating compute like a commodity, the way we treat oil, for example. But one of the...
Or the way Enron treated electricity.
Exactly. I think that is very well said.
That's a different ending. But I will say, to your point, 20 years ago, and it may still exist now, I'm dating myself, people traded DRAM DRAM, and was a tradable market.
Right.
And I think they're just trying to do the same thing. And who can blame these people, these guys in this warehouse, bros, who maybe are forgoing a romantic relationship to work on their AI ambitions, Madison?
I see you see the stories that I'm working on.
That's a story that you're working on. Maybe you guys know somebody. Why not get ahead of it? Get bought by a bigger firm, get rich.
And get over 30 million from Andreessen, which is what happened to those guys as well. And, this is part of the broader demand story. We had Greg Brockman talking to Axios, one of the co-founders of OpenAI, saying that we are going towards a compute-powered economy. The people working at these AI labs see compute demand is never ending. It's something that'll never be satiated. So then if you have that belief, again, 500 billion is nothing.
Well, I think that the key question and what's changed potentially now and why this announcement is coming now is this idea that historically you wouldn't be able to securitize something like compute or chips because you didn't know the residual value, you didn't know how it would depreciate and what that meant for collateral, and then also the direct tie-in to revenue. And when you talk to people, do they tell you that's changed now just because of the business models of the LLMs, and how much faith do we need to put in to an OpenAI or an Anthropic in light of all this, especially if we're looking at, $500 billion market potentially?
Exactly. One investor who I talked to yesterday told me he's worried about something called diminishing model returns. This idea that we already have these really amazing models, and it's not clear that the AI labs are going to need as much compute going forward to train better and better models, because Fable 5, Fable 7, whatever, it all starts to sound and look the same after a while, especially because the majority of people aren't needing the frontierest of the frontier models. I mean, look at what's happening with Google. They've already decided to kind of, for better or worse, roll back their AI ambitions because they went free cash flow negative, and there was not necessarily a great reaction to that. So that's one of the things that the bearish investors I talk to are worried about, that AI labs that are all in on compute today, they may longer term not see as much return on the models that they are training that are really expensive and need all of that compute.
Yeah, I think the analogy that Jamie Dimon uses is you're not going to take a Ferrari to go buy eggs at the grocery store. You don't need it for that purpose.
Exactly. You can do your Ford for that.
Yeah. Absolutely. Yeah. Madison, thank you.
Green across the board today, so a little bit of relief, obviously, after the CPI print. Certainly the AI bulls getting a nice lift from Supermicro and CoreWeave, the beats, the raises, et cetera. And Ed Yardeni goes to 8,400 now on the S&P. 8,250 was the prior target, which at the time he said could be a little conservative. All right, so the words, then the action. So he raises it. Says, quote, "We've never seen consensus earnings expectations rise so quickly for the current and coming years as they have since mid-2025. The result has been an earnings-led melt-up in the stock market to record highs." That's where we find ourselves. There's no reason to think that that's going to change as long as the earnings picture remains what it is.
No, and congratulations to Ed on calling the 20s for exactly what it is. It is the roaring 20s, specifically attributable to the earnings growth. Now, Ed is the highest on the street. If you look at the S&P targets, the actual consensus price is 78.45. But we're looking now at taking profit margins towards 17%, which is absolutely staggering if you think about where they were just 5-6 years ago, kind of wallowing around 10%. The earnings growth is the driving force for sure. Ed right now is the highest on the street. And I think what we will benefit from is continued participation as we move higher from the systematic funds. We're kind of sitting in place right now off of this 3% gain that we've had in the month of August, really strong out of the gates. But I'll tell you what, we break out above that August 5th, 77.93 high. I expect systematic to engage further and move the market towards 8,000.
Okay, so I mentioned, obviously you get the news that you really needed, Bryn, today. Does the Yardeni target sound reasonable now to you? Because I said yesterday, I think 8,000 is the floor. It feels like it from the street, at least. Everybody's gotten now to at least 8,000, or certainly most people are getting there. And now he ups the ante at 8,400 because of this FEMO, right? Not FOMO, FEMO. It's the earnings-led momentum.
So I typically, ignore year-end price targets. That being said, Ed's been doing this for decades. He has a very good track record. And so I think directionally what he's saying makes so much sense, because you also have to think about how the construct of the S&P and the NASDAQ, but for the S&P for earnings has changed so much. So yes, Nvidia is still the number one holding in the S&P, but now Broadcom and Micron are also in the top 10. Obviously, Broadcom's been there for a minute, but Micron's now broken to, I think it's like number 7 or 8 position. And those earnings from those 3 companies are going to continue just to be monster. And so I think if you are looking at earnings from these specific companies, especially the Micron Nvidia, you can math out very easily why his number at 8,400 sounds plausible. And so I do think investors do need to understand that huge shift of the constitution of the S&P and the NASDAQ has changed, which is going to continue to push those earnings growth numbers higher.
Shan, what do we think about this market?
Well, I mean, the crazy thing, right, is that the S&P 500 is actually underperforming other global equity markets. And so I think if you look at the tech PE ratio, we've seen that compress pretty markedly. We're seeing the opportunity for this pivot, if you will, in terms of the next phase of AI. But I think it's most important to kind of counter some of the enthusiasm with the fact that many are still concerned about the recent unwind in memory. Was that fundamental? Feels more technical to us, certainly the degrossing. The reality is, too, you also have the news from Nvidia about these memoranda of understanding. That clearly is indicating that there is going to be a wider participation. We've seen it in the credit markets already in terms of funding investment, this issuance, increase in investment grade issuance. You're seeing it now utilizing the alternative private equity managers, private credit managers to also fund this growth. The bottom line is that all of this is underlying the economic momentum that we have globally. We're no longer, especially here in the U.S., Scott, our economy is not based on what's happening with the consumer. And so all of these concerns about the labor market and inflation and the Fed, the reality is that the tenor of economic growth has changed in the United States, and the companies that are performing well from an earnings perspective are benefiting from that and are likely to continue to benefit from that, even if there are pockets of weakness in parts of the consumer market, for instance.
Big week for the AI bulls, undoubtedly, right? The Nvidia financing news, no money to be seen yet, obviously, but the announcement enough speaks to the environment and the expected demand that's going to be there. CoreWeave blows it out, stocks ripping. Supermicro gives a good guide, stocks higher. So this has been a week of AI trade validation in many respects.
It's been about validation. It's been about the messaging and how they're doing it. Remember, people were worried about how and why companies like Oracle and Microsoft going out into the private sector and gaining debt. This consortium, even though it's still not completely tied together, this consortium in terms of how NVIDIA put this together, number one, and number two, how they communicated it, Scott. We need information in the market, and they did a great job talking about how that's number one. Number two, in terms of the tech trade, we've said for 10 years that tech is becoming the consumer staples of the U.S., period. And so earnings have become excessively stable, but Ed nailed it. And we talked about this on the show yesterday. In the second quarter, we've never seen in the history of watching earnings revisions for well over 30 years, we've never seen a revision of earnings like that. And when you see that, that is real. That is real. And so what's going to end up happening is you're going to continue to see these types of revisions over the next 4 to 6 quarters, and 8,400 is clearly in the way.
I mean, Bespoke today talks about the beat rate for tech, the highest, 85.1%. One of every 100 tech stocks that have reported, 85 of them have beaten expectations. You have had, according to Bank of America, who watches the flows of what their institutional clients are doing, tech's second biggest inflow ever. So driven by hedge fund clients. Remember, we've been talking a lot about the degrossing from hedge funds. Mm-hmm. There's been a lot of deleveraging. The positioning environment, the field, if you will, is cleaner now. Tech saw the second biggest inflow week of all time. Money's going where they think they can get a nice reward. There's no doubt about that. This trade seems to be back in a big way. If it wasn't gone, it was parts of it at least were just taking a rest. Now the chips and the momentum trade, they were taking more than a rest. They had to puke up a little bit before they felt good enough to get back in the party.
So we had this 19% move from the end of March through June 2nd. That took you up to 76.20, an all-time high. And then the market, to your point, Scott, it kind of had this consolidation to lower trade as you moved through the month of June. We're now rebuilding positioning once again. The catalyst is clearly earnings. And I think, Scott, we're getting in front of NVIDIA earnings. I think if you...
Exactly 2 weeks from today.
Exactly 2 weeks from today. So if I can, let me just walk you through why I think we're getting in front of it. First of all, analyst community, 96% buy rating, 303 price target. Here's what happens with the revenue growth. The revenue growth reaccelerates. Remember we were hearing about revenue growth moderating? You're coming in, the consensus number is 96%. That's the best figure in nearly 12 months for NVIDIA. Now you're going to see earnings growth, 114%. You're talking about free cash flow generation that's going to come in at $47 billion. Next quarter, they're going to guide to $100 billion in revenue. Think about how staggering that ultimately is. So I think the market is getting in front of what I think universally people believe is going to be a really good quarter. Be a little bit careful with that on the other side of earnings.
I was exactly thinking
Be a little careful with that on the other side of earnings, but I think we are working ourselves up towards that previous high at 236 for sure that we had in May.
Bryn and Goldman says it's going to 285. They reiterate their NVIDIA buy, but Joe makes, I think, a really great point that we just came off one of the best weeks that this stock has had in an awfully long time. It's been on a nice run here, okay? You can look at it over, that's month to date. Thank you, guys. That's a good chart. That shows exactly what I'm talking about. Therein lies one of the problems, okay? So expectations are elevated too. Watch out on the other side of earnings in a couple of weeks.
I mean, the growth of this company, though, is so ginormous that I think it's been a huge laggard with the growth, which tells you it's like people just still don't believe this growth is going to continue. But to Joe, walking through those revenue and earnings numbers, they are. And to do $100 billion next year is amazing. And so the stock continues to get cheaper. I think it's just been consolidating, right? What do we have, a $5 trillion market cap? But this stock is cheap. It should be at 280. 220 is at 223 is inexpensive. So we'll see if it can break through that technical ceiling around 230s. When it does, I do think it will. I think it's off to the races. But that 230 definitely is a ceiling that it needs to pierce through. But it's been an underperformer relative to the Microns. A bunch of different stocks year to date. And so I do think there's an opportunity for catch up, especially with Elon saying with SpaceX that they're pushing all of their chips in with NVIDIA. That's a huge, huge new customer that was not underwritten a month ago.